to episode 63 with Chris and Hao. I'm Chris, that's Hao, and we're going to go through today some updates for the year. Actually, updates from last year. This is our first episode in 2025, and we've got some cool things that we saw at the end of the year that we thought we'd update all of you on. First item is record low cash allocation. When's the last time you heard that? People were just sitting on cash. Turns out it's
4%
flipped.
Doesn't entice people anymore.
Right.
Next is Fed changes its tune on rate cuts. I hope this is topical. This episode's prep really occurred in December, so
No, I think it is because I don't think that really hit the news. Like Fed changes its I don't think it was there.
yeah, we'll find out when we go through it.
There's a lot of like politics that was on the news feed versus like what the Fed was saying. So I think it's not. Yeah, I don't think it was. Anyway, Mag 7 still dominating. Had another good year last year.
Wasn't even close. PCE inflation lower than expected. I think that was just the last reading of the year.
And Washington State minimum wage increase.
More than the state of California, which is pretty wild.
Pretty wild. You know, for a while there, we had the most expensive gas, too. Took that record away from you guys. Man, it's crazy. It's crazy. Okay. Record low cash allocation. Okay, first of all, what does this mean? What does cash allocation mean? Maybe let's just explain to our listeners what we mean when we say cash, and then let's dive into what you say.
Simple terms, cash is anything that is not really checking savings account from your bank. It's anything that is in your invested account on the sidelines. Specifically, this is going to be cash held by, I'm using air quotes, smart money. And Bank of America takes a global fund manager survey, and they say, hey, we're doing this with our allocation heading into the year, and we're doing that with our allocation heading into the year. So this is investable dollars that money managers control.
So you said something earlier that just reminded me of a prior episode. So you were saying 4% on cash doesn't entice you for that long. And of course, after a year where the market has a really good return, particularly like the S&P.
That's something I want to take back, but...
okay, but hold on. No, it reminded me of the survey that we covered, probably like 18 months ago. And it was that survey on what does an average investor think that their return is going to be?
Yeah.
And then what does a financial advisor say that their client's return will be? And it was like the advisor said 7% on average is what you should get. And the individual was it like 20? 22?
I think 23, 24%.
23, 24? Yeah. And so exactly, right? That's like, yeah, I can earn 4% of my cash. I feel good about that. But, oh, wait, the market went up 20 or 25. I might as well get into that. Now you got swayed.
Yeah. Well, the market turned out to be retail, right? Like it, at least in 2024 performance, at least until the very end, right? So it was up 25% to end of the year. The NASDAQ was up 29% to end of the year. So yeah, advisors were, again, we're talking about averages. You got to take the bad years too with the good years. And if you're not staying in the market through both, you're not going to get that average 7% assumption. And JP Morgan does a study too, where retail investors generally underperform the regular 60-40 portfolio by like 3% because they're always jumping in and out.
Because of trading. Yep. My question here is, okay, so cash is at a large underweight. So that means that people previously were holding cash and now they aren't. What do you think they were thinking in 2023 when the S&P was up 25% and the NASDAQ was up 50%? That year, right? Like what was the pivot this year? Is it true FOMO? And they're like, all right, I got to get rid of my cash. I've missed 2 years now.
Yeah.
What do you think happened?
Again, Chris and I are very neutral for dumb money, smart money, and we're quick to call out smart money for being dumb. I think the only difference between last year and this year is valuation, and the smart money is chasing a little bit because they want their they want their bonuses for 2025, right? Mm-hmm. Because it's obvious through all the articles that we're seeing is bonus season had been pretty light for Wall Street. And the last year was probably a good time to invest, even after a pretty strong 2023, because we were looking at pretty close Fed to cutting rates. Again, it was pretty iffy at that moment, but the Fed was pretty clear saying they were going to raise rates. So how do you know the pathway to lowering rates? Well, stop raising rates first, right?
That's a start. Yeah.
It's just a matter of how much time passes before you cut rates. And I think the smart money, I don't know, what they must have had their head in the sand. They must have liked international. They must have liked something else that wasn't the S&P, because the fact that they like it now after probably the Trump presidency, deal making is going to open up and businesses are going to go business again.
Yeah.
I don't think, I think that's stupid. We never invest with presidential promises. More policy, but I think what we've seen with Trump, who hasn't even been inaugurated, it's January 10th at 2:30 Pacific. He's got 10 more days, but he's already had impact on the budget, right?
Yeah.
He and co-president Musk came in and said, we don't like this budget proposal that was bipartisan.
Yeah.
And it risked another government shutdown, just a few days ago.
Yeah. Interesting. I mean, I want to take us down a little bit of a tangent. I feel like a lot of the initial, let me even back up from there. Some areas of the market have round tripped since that initial election bump, dare I say a second Trump bump. So like the most alarming thing to me was small cap stocks jumped 9%.
Yeah.
The day after the election. So this is an index of 2,000 stocks, the Russell 2000. 2,000 stocks moving 9% is huge. And they've round tripped. They've come back down to be at the same return they were pre-election. And so there's been that kind of thing that's happened. The bank stocks ended up actually having a really good year. They were like second or third in terms of the S&P performance. So they actually had a really good year. But I just think, trying to, again, relate that comment back to your points, yes, this election has already had some influences on markets, but aren't the markets, how bullish are the markets? Like, really bullish.
Yeah. And what's real, right? Wait, hold on. My daughter is home from school early. Let me
go get her.
All right, give me a sec. We're gonna leave that in, right? The weird.
We should.
Okay.
Yeah. I just gave a little commercial while you were gone.
She wasn't home early. It was just, yeah. She goes to after school clubs, so she gets out normally around 3:30. It's 2:40.
Yeah.
But she doesn't have after school club today, and that's my fault. So
yeah, all good.
Yeah.
Glad everything's okay. That's the most important part. Okay, I took us down a tangent there, and we were talking about
what's real or what's not from that.
Yeah, kind of. Yeah. What do you think?
One, I think you'll see through the newsletters that we published out. They're all written. We doubted the narrative that small caps are going to go on this deal-making frenzy and totally ignoring higher rates, because rates has started creeping up all the way through the election. This occurred in September, right? Rates were around 3.9%. They're now 4.8, 4.7%.
Yeah.
And a lot of it was attributed to the expectation that Trump's policies are going to be so loose that the economy is going to start booming again. But what does that do when we have inflation right above target, right? That's going to reignite inflation.
Right, and it's going to keep rates higher. That's probably where you're going. I stole your punchline, but exactly.
Yeah, completely. So
there you go. We'll leave that part in, yeah.
The natural move would be to keep rates higher to tamp down inflation. And I think the market is mired in a bit of a sell-off, specifically small and mid-cap companies, because I think that's the bigger driver, right? They're less profitable, right? We established that the Russell 2000, which is all the 2,000 smallest companies in the U.S., 60% are non-profitable. So how do you operate? You're borrowing.
Yeah.
And if borrowing costs shoot up from, let's say you pay 10%, they shoot up to 13, 14, 15%, That's really expensive. And that's a big hurdle for your company to clear, but you still got to operate. And that's what's pushing down these valuations, at least in the interim.
So we've mentioned the Fed a couple of times. I feel like we should just move into our second point. So Fed changes its tune on rate cuts after cutting in December. So the Fed has cut 1 full percent in 2024. They came out with a jumbo cut or a double cut. So a cut is considered 0.25%. Their first cut was 0.5%, so jumbo cut. Then they did 2 more subsequent cuts before the end of the year. So 1 full percent off of peak rates so far. Why don't you just share with us what is the Fed forecasting for the rest of the year and just what happened in that December meeting? Because I think it was pretty monumental what they changed in their language.
Yeah, the Fed's forecasting does diverge from the bond market. So we do have eyes on what the bond market is assuming over the next 2 years. Mm-hmm. And then it's going to go track the same timeline as the Fed. But the Fed is a little bit more optimistic in terms of how much they can cut over the next 2 years. And the bond market is saying, no, we're seeing higher for longer. You got maybe another cut before you start having to flatten out. Mm-hmm. So this is a chart by JP Morgan where it describes the bond market is assuming the settle phase is going to be about 3.8%, where the Fed is assuming the neutral rate. Neutral rate being the rates are at a point where it's not contracting the economy, and it's not also at a point where it's not invigorating the economy. Everyone assumed that neutral rate was 3.0%. Now it's decidedly higher at 3.8%. Why does this matter, right? Like, these rates that we're talking about will impact credit cards, savings rates, auto loan rates, a lot of loan rates. And the higher it is, I know 0.8% doesn't sound like a lot, but we're talking an impact of trillions of dollars. So the bond market, for its part, is saying 3.8 versus the Fed saying 2.9 as a neutral rate, or the target rate that they're trying to achieve. That's
almost 1% apart. Yeah, it's huge.
That 1% difference, which the bond market has been right so far, it's monumental for the economy, because that 1% difference is,
well, it's like
difference
30%.
between 6.5% mortgage rate to 5.5%. Like that. Imagine a 5.5% mortgage.
Such a deal.
Yeah.
Such a deal. So I think what's key here, the key understanding is that what flipped is that the Fed is now predicting lower rates than the market. So prior to all these cuts and prior to the December meeting, the market had expectations of rates going lower than what the Fed was saying. So the market was ahead of the Fed.
Yeah.
And now that's pivoting.
The market was saying the Fed should have cut already. I think back then, in hindsight now, the market was wrong then. It might be right now.
Well, and now the market is saying the Fed won't cut as much as they're saying.
Yeah.
So why? What changed?
A couple of things. The jobs market came out today. We beat the non-farm payroll expectation by about 100,000 jobs.
Oh, wow.
Unemployment dropped from 4.3% to 4.1%. And keep in mind, like a healthy economy, unemployment's at 5%. So there's like an implied percentage difference of overheating in the labor market. Do we want to get back to like the 2022 job market? For workers, it's awesome. They could just jump around, but that jumping around causes salary spikes, wage increases, which is causing price increases, right? Mm-hmm. And I think that was something that the Fed was trying to tamp down specifically with the rate hikes. And now, by cutting 4 times last year in 3 meetings, that's where we're saying in hindsight they're regretting that.
And you just gave me some good news that jobs report was better than anticipated by a
Yeah,
lot.
where the good news is bad news. Bad. Right?
That's where I was going exactly. So that's job market was really good, or job report was really good, and inflation fell. Like, this is great, and the market went down. So why is that?
Because interest rates are really driving everything, and it's become a narrative again. The Trump bump has officially been completely erased. So
Round tripped.
Yeah, the rally round tripped. And again, we were always hesitant about jumping on a presidential boom or bust. That's a bad way to invest. So again, we don't feel sorry for anyone who round tripped on that one, especially if they took leverage for like being over exuberant. The biggest thing is going to be how tight the Fed keeps the economy or keeps rates.
Yep.
And again, I think we can argue how effective these rates are on the real economy. I doubt it has as much impact as, on an NVIDIA of the world or a Microsoft, where they're just, you're just helping our cash pile grow faster.
Yeah.
Right? We have hundreds of billions in cash, and you're raising rates on that yield versus a smaller company that supplies them, for example. They're going to be hurting. And I think, one, the sell-off doesn't really jive with some of the narrative, right? The narrative that's returning is, these tech companies have profits down the line. Therefore, higher rates are going to impact them more than value companies. Remember that we were talking about in 22?
Oh, yeah.
That was a whole load of just false narrative, right?
Yep.
Because look at Apple, look at Google, look at Microsoft. They have massive treasure troves of cash. And guess what they're swimming in just the interest, right? So I think that's going to turn around. Some of the Mag 7 has been selling off because of that. I think that's a mistake from the markets. If rates persist, you could see another 2023 level dominance from those big companies.
I just want to read some quick headlines here after today, and then we can move on from this. And by the way, I'm curious how this dot plot that you described earlier has changed now after today with this job report. I think that'd be interesting as that gets updated. But biggest headline: stock sell-off after job report dashes rate cut hopes. Another one here: jobs report fuels treasury yield surge as 5% threshold looms. So this is exactly what Howe's talking about here, is that too much good news is bad news, in that if the market shows bad news, that means the Fed lowers rates and people are happy. But if things just keep roaring along, forget it. Rates don't go down.
Yeah. On the immediate reaction, the VIX, which is the volatility index, spiked 74%.
Today?
27.62. The NASDAQ sold off 3.5%.
Yeah.
S&P sold 3%. And then the most rate sensitive corner of the market, Russell 2000, negative 4.4%. And that was immediately after the Fed spoke, saying, hey, we need to pump the brakes again on the economy, specifically on rate cuts.
Well, but they removed some language, right? Because they were previously saying, we will cut 4 times next year and it'll be delivered. And now they said, we will cut as needed, or based on data.
Basically, they said we'd be lucky if we get 2 cuts this year.
Yeah. Okay, let's move to the Mag 7, the area of the market that is completely uninfluenced by interest rates and doesn't seem to care about anything.
Again, not financial advice, but the Mag 7 is hurting like everyone else, and we have the same makeup in 2023.
Okay, I will say this. 2024's markets were far healthier than 2023 and 2022. Why do I say that? 2023 was a big recovery year, if everybody remembers that. 2022 was the big sell-off year, and tech sold off a lot. Like, that was the year where Meta went down like 80%, Amazon was down like 50%, Microsoft's down like 30, 35, right? Like, big sell-off. Other stocks also went down a lot, but those are big size companies, so it really influenced the index. Following year, a lot of those companies came back. Not all of them. It was sort of unequal or uneven, but a lot of them came back. And so in 2023, the S&P return was like 25%, and the NASDAQ return, which has a higher weight in the Mag 7, kind of those 7 to even the 10 top companies, was up 50%. And that's not really healthy for markets, right? You don't want to see 7 to 10 companies out of, a lot, thousands, powering market returns. 2024 was far more balanced. In fact, for most of the year, the S&P was a skosh ahead of the NASDAQ, which is really good news.
Yeah.
Right? That says that the 500 top companies in the U.S., not just the top 7, are doing well.
Yeah.
NASDAQ ended up inching out the S&P right at the end of the year, but their returns were very similar throughout the whole year.
Yeah, if you sneeze, you did miss the small caps and mid caps outpacing the S&P. We
True.
were doing cartwheels, and then very short lived.
True. Yeah, it finally started doing something. Okay, Mag 7. What do you got?
Yeah, going off the backs of what Chris was saying with the NASDAQ, we isolated the Mag 7. So in 2022, the Mag 7 underperformed the S&P by nearly 30%. Remember that sell-off for Netflix and Meta especially, super painful.
Yeah.
But the corresponding rebound, it outpaced. Again, the S&P had a really good year in 2023, even better year, because you were up 63% above the S&P through the Mag 7 in 2023. That's when we started really harping on concentration risk. Right, this rally didn't seem real, or it didn't seem sustainable, because it was just concentrated to the top seven names. You take out those names, the S&P was up 5%,
Something like that.
Yeah.
Yeah.
And 2024, we were convinced that the rest of the market was going to catch up. The Mag 7,
It did for most of the year.
yeah, it was. The Mag 7 did beat the S&P by 22 full percent. And the S&P, as I said, was up 25%. So if you had the Mag 7, you were up pretty handsomely.
Yeah. Okay, but I was gonna dog on Tesla, and maybe I won't. Maybe I won't. It's like, it's not a tech company, right?
Yeah.
We've talked about this before. Tesla is not being priced as a car company. A car company is a bad business, right? It's a low margin business that gets squeezed. There's a lot of squeeze. There's a lot of competition. Are they the EV market leader? Sure. Do they need to add more range to their cars? Yes, I think they do. But that's not what we're here to talk about. So my point is, they've had declining car sales and declining margins due to competition, yet the stock's gone up, right? The stock, since the election, has gone up a ton. Why? Because the market's not betting on Tesla just making and selling more EVs. The market's betting on Tesla doing something other than EVs. And that's what's getting priced in. So to the extent that that happens, maybe that valuation gets supported. But to the extent that that doesn't happen, then it'll be a really interesting stock to watch. I don't know. That's my thought.
I'll twist it a little bit with the Tesla story, because Elon
Okay.
Musk has been a resident in Mar-a-Lago. I think he has Trump's influence for sure, or influencing Trump. And I think a lot of policies will be tilted towards a benefit of either SpaceX, Tesla, and or Musk's umbrella of companies. Mm-hmm. And I think that's what kind of the reward has been since the Trump win. Right? Tesla was up 100% in 5 weeks.
Oh my God. Something
Post-election?
like that. Yeah.
So even for a tech company, one of that size as well, that's a lot of money pushing that market cap of Tesla over a matter of weeks.
Which again begs that question, like, what is actually getting priced in? It's not like there was a new car announced.
No.
It doesn't make any sense. And so, unless robots, robo taxis are there, but I believe there are companies that are beyond Tesla's tech.
Yeah.
Like Waymo and stuff. And so like these companies, potentially, like Waymo sits inside of Google, right? The unlock could be spinning out a Waymo, which is maybe a, Tesla-sized company, out of Google. Anyway, my point is, I just don't get it. That's my point.
Yeah, maybe, again, there's going to be things that are going to move that don't make sense. And I think what we are trying to get listeners used to is the aspect of randomness.
Yeah.
And again, just because it topped out at $4.50 a share doesn't mean it eventually get back there. Doesn't also mean the wide range of outcomes for Tesla in my mind is like, if it goes to 100, would you be surprised?
No.
If it goes to 500, would you be surprised? Like,
Nope.
Yeah, those two outcomes were like totally within the realm of possibility here.
The Y chart's value score, it's a solid 1 out of 10.
Yeah.
Good. Very nice. Very nice. Meanwhile, Tesla drives by out front. There you go. Okay, moving on. Inflation. Are we still talking about inflation? Boring.
We are now.
Every time we put it in here. People
so
should
this
just
is the
email
official
me and
Fed
say,
number.
guys, like, stop talking about inflation. It's so boring.
This is the preferred Fed data point. It's this PCE. I know headlines are focused on CPI, but PCE adjusts for when people like Chris and myself see eggs are too expensive. We're gonna move over to what's an egg replacement? Milk.
Nothing. And they're sold out. They were sold out last week, and you and I were texting each other.
Yeah, I was at Whole Foods in the Bay Area, and there were literally 2 cartons of eggs in the entire
With like
fridge.
3 broken ones in each.
Yeah. So I sent Chris a picture of an empty fridge of eggs. Again, Trump can't fix it. It's avian flu, right? But that's kind of the fault of consumer confidence, because consumer confidence has also driven up. And if egg prices stay persistent, do you think that goes down? Gas prices have actually started to bottom. I think gas prices have nowhere to go but up. But it shows you how fickle consumer confidence is.
My confidence is lower when I see the egg shelf empty. I'll tell you that.
That's pretty worrying, actually. Higher prices for eggs we could probably deal with, but like 0 eggs?
It's so weird. I mean, when you walk in, and maybe, yeah, it's like you walk in, I don't know, maybe this sounds crazy, but like you walk into a store in America, and I guess it's the expectation that like they have the things, you know? Like it's one thing to be sold
We're
out
not
of
North
like,
Korea here.
well, or wherever, right? It's like,
Yeah.
it's not like, you know, you went into Nordstrom to buy your limited edition Nikes and like they sold out before you got there. Like, okay, I
Yeah.
get it.
Woohoo.
Like, but you know, these things that are just like staples, how can you run out? And I mean, the last time I was at the store, they were sold out. So we've been buying like 18 packs of eggs. I mean, we eat a lot of eggs, but whatever. They didn't have any, right? So I'm standing next to this lady, and we're both looking at it, and there's one brand that's left, and there's a bunch of 12 packs. And I'm like, all right, well, you take half, and I'll take the other half. You know, like, of course, it was limit 3. And so as I'm reaching in and I'm grabbing my 3, and of course, you got to check, you don't have any broken ones in there. And I look back in the refrigerator, you know, they have like these shelves back there.
Yeah.
And there's a ton of eggs, like in boxes. I'm like, what are you guys doing? Unbox those. You know, Whole Foods is like holding them back to redistribute them across their handful of stores in the area or whatever.
Is that the real reason, or is it the
No,
image of scarcity? It's like, I'll pay you $7 for 12 eggs because I see there's only 4 left. Or you know what I mean? Like that.
We should have an FTC probe here on like, is Whole Foods driving up prices for eggs because of scarcity? Because when there's like 20 cartons left, I'm going to buy as many as they allow me to, which was 3. The limit was 3.
So you're an egg hoarder, kind of like toilet paper?
I will buy as many eggs as they allow me to, because the next week they might be out, and eggs last. I mean,
Yeah.
I'm not going to go buy like 100, but like, you know, I'll buy 2 weeks worth, because at this point I feel like there's a good chance I'm going to show up tomorrow at the store and there won't be any. And so like, yeah, I'm buying more.
Yeah. Again, despite high egg prices, people feel better about the economy. I think that could be pointed towards Biden to Trump. It shows you how bad people felt about Biden, right? And I think PCE has been slowing down. And I think that confirms the need to cut rates. And again, this article was published in December. The fact that we got such a hot jobs number, 100,000 jobs created above expectation. And expectation was like 126,000. So to beat that,
Crazy.
yeah, when you think you have a crummy economy, again, that's why we always point to the data, not people's feelings.
Mm-hmm.
And PCE prices are coming down. At least the prices of things people are spending on, if that makes sense. Yes, you're going to find something outlandish like an $18 Big Mac in Connecticut, right? But I think you're going to see data like this continue to come through because people have already started substituting down. And again, we went on this egg tangent, and there's nothing else to substitute with. But despite eggs prices coming up, people feel better about the next 6 months than they have in
Because
quite
the
a
market's
while.
up. Yeah. I mean, it makes sense, right? Like, what would be worse than high egg prices and like your 401k is down 15% or whatever? Like, that would suck. But now it's like, God, egg prices, God, they're out again. I got to buy 3 the next time I see them, right?
See, we're rationing eggs. We're not, my household is rationing. We're not hoarding.
I'm not hoarding. I'm just buying 2 weeks in advance. I'm not hoarding.
Yeah, contributing to the egg shortage.
If you want to come over to my house, I'll sell you some eggs. That's all I'm saying.
It might be cheaper to fly up to Seattle and fly back.
There might be a premium
Whole Foods.
on those eggs that I'd sell you because they're a prized possession. But
all right, last topic. This is probably, I don't know, depending on where you land. Minimum wage, controversial? No? Yes?
I mean, I have a big question when you're at when you're done with this, when you're at the end of this.
So minimum wages across the state of Washington is risen to $16.66. Just for reference, California's minimum wage statewide, again, there's going to be pockets like in King County or going back down to California and San Francisco County area, there's a higher minimum wage, right, that's set by the local county. Mm-hmm. But $16.50 for the state of California, and arguably more populous than the state of Washington, which has a statewide minimum wage of $16.66, up from $16.28 an hour. We had quite a bit of internal discussion of whether that's right or not. Again, that's kind of where the controversy comes in. It's restaurants have definitely increased their prices, but what came first, the chicken or the egg? And again, not to really harp on eggs, it's just are states mandating, counties mandating higher minimum wage because restaurants are charging more, or restaurants have to charge more because they have to pay higher wages? It might be a bit of both from my point of view, but those things are hard to draw a line from, right? Your favorite restaurant raised prices by 20%, but they have other input costs, right? If especially if they're egg centric, they're a brunch place, their costs can easily have gone up double digits in a matter of months.
Great point.
And again, that's why we don't recommend the restaurant business. I think the best restaurants, like you're talking about the best restaurants, their margins are like 3%.
Yeah. It's like grocery stores. It's hard.
Yeah.
It's hard to make money. It's hard business.
So again, you're a business. And again, I've been pretty frank about businesses. Like they don't deserve profits. Like if you're a business that can't be profitable, then you don't deserve to be a business. Mm-hmm. We had the controversy with Airbnb. I think that applies to really any business, right? I could see Subway going out of business. I walked into a Subway just to buy like that foot-long cookie for my kid and looked at their foot-long regular subs, $20 for a stupid Subway sandwich. Yeah.
Hold on. There's no $5 footlong anymore?
No.
Like how much is a footlong is
$20. Like
$20?
Yeah.
I gotta go to Subway and check this out.
It was like $18.99 for like one of their subs.
Man. That's crazy. I gotta go to Subway now and check this out.
Again, if you're charging those prices, no one's shopping there or no one's eating at your store. Do you deserve to be in business? You know what I mean? But then, do you deserve?
Meanwhile,
the further you get up the food chain in terms of like quality, and you're paying people, let's say $5 an hour, what kind of wait staff are you going to get applying for your business. I think it's a delicate balance, and I don't envy business owners or restaurant owners at all. And again, I pretty much established I don't feel sorry for them, but you see what I mean? Can the state of Washington say, hey, you're a business, you got to pay your people this? To a certain extent, maybe there should be a floor. But, Chris, you run a business, right? Like, if the state of Washington says you got to pay X amount to every employee, what are you going to tell them? Take a hike, right? The market should determine that, but again, that could get really messy really fast.
Yeah, I think there's some changes in there with like salaried, like full-time exempt employees, like salaried employees, and there's pretty high minimums now, and I think it's unfortunately going to push. So it's like if you are hourly, you don't qualify for overtime, then you are effectively a salary, and like those salaries were pretty high. And I'm just thinking, like, for so many jobs, like far higher than the minimum wage, right? Minimum wage jobs are really defined by hourly jobs.
Yeah.
And so I think it's going to unfortunately push a lot of businesses from the salary model into the hourly model, which I think then for the employee, you don't have that consistency. You could have less hours 1 week or 1 month.
Yeah.
What if you don't get benefits because of that? Like, I think there's a lot of challenges that ripple down. It's not as simple as just mandating you pay people some minimum amount of money. I don't know. I think I feel like it's going to be interesting to see how restaurants do actually fare with this. The headline rate is $20, right? So it's like $20 an hour in Seattle.
Easier to say that. Yeah, for sure.
Yeah, because like Washington is lower than Seattle. Seattle's higher.
Yeah.
Well, last year it was basically $20 too. And so like 1997 and it's like 20, I don't know, 70 or something like that, right? So it's basically the same. But I think what's the issue is with restaurants is there's some sort of a like exemption or something that's expiring. And so restaurants aren't getting some credit that they used to get. And so that's like what's so detrimental to restaurants. Where I was going to go with this, with my huge question is, do you have to tip anymore? If restaurant workers...
Okay, I was expecting something completely different.
No, that's where I was going to go. That's where I was going to go. Because tipping has become out of control.
Yeah.
Right? And so if the cost of the things on the menu keep going up and up and up and up because the minimum wage keeps going up and up and up, and the cost of goods too, right? Eggs, like we talked about, is also higher. So if the input costs are higher for the business, but then the workers are making more money, do they still do they still deserve the same amount of tip? Because part of tipping, at least the theory, is, well, okay, this person, deserves to make more than whatever they're making because of the level of service that they're providing. Does that change? Does that standard 20% tip everywhere you go type thing change now?
Yeah, well, or even the pre-built tip, right? Like, and they don't tell you.
Mm-hmm.
We added ourselves an 18% gratuity to your bill.
Mm-hmm.
Well, that doesn't really sit well with me.
Mm-hmm.
But again, tipping, I think, does lead to like a free market component where like someone's generally, again, I've seen outstanding service not get tipped, which sucks. But I've seen poor service on the flip side get tips, so maybe it averages out.
Yeah.
Again, I would never go back to the food industry at this point unless something catastrophic happens with, just life in general. But you see what I mean? Like it's hard work. I get it. Is a tip warranted if you're taking it to go? I would say no. But again, if restaurants explain, hey, tips go to the cooking staff, I don't know. It's muddy. It's gray. And then the fact that the local governments are stepping in and saying you got to do this, this, and this is like, well, one, can they find good employees and have them stick on their own? Look at the Costco model. They don't need anyone to tell them you should pay and treat your employees as such, and they have the highest employee satisfaction ratings across the S&P 500.
Mm-hmm.
So there are companies that have found ways to do it.
Mm-hmm.
But again, there's companies that have taken incredible advantage of their employees. You know, Wells Fargo being the poster child for that.
Mm-hmm.
And I got to be careful what I say here. You know what I mean? Like, if you say something you think it's one way, it probably isn't that way, if that makes sense. Because I'm not a business owner. I don't work in the restaurant industry. Definitely don't work for Wells Fargo. But you see what I'm saying is it's complicated enough without government intervention, and then it gets suddenly more difficult.
Yeah.
And again, I'm not trying to say I'm anti-government, but where's that barometer? And you're setting prices for someone's wages, and can restaurants sustain that? Maybe in like Pike's Place, but not many other places, from what I could tell. You know what I mean? Like it's just,
Yeah.
I don't think it's very easy to answer.
We'll see. I mean, I think that's the answer. We'll see. I mean, of course, the news is littered with this restaurant is closing and that restaurant's closing, and they cite that, you know, minimum wage laws are too much to keep up with, blah, blah, blah. But of course, that's just what's sitting in the news, right? So
Those restaurants are going to close anyway. They have the Subway model. They're trash. Yeah, again, I'm pretty heartless, but they don't deserve to be a business. Again, but
Subway
again,
is the best performing franchise.
What's that?
I would argue that you're wrong. Subway is the best performing franchise that you can buy.
Yeah.
Legitimately. Like they have more locations than anywhere else, and they're a great franchise. Okay, Chick-fil-A is probably better.
Yeah.
Chick-fil-A is more profitable. But Subway turned their model, and look, Blackstone just bought Jersey Mike's, different, you know, similar product, right? So like they've got to be seeing something.
No, I challenge you to walk into your local Subways. You could probably count on your hand, a single hand, how many customers they get in the 2-hour stretch that you do an observation period for, because their prices are outlandish.
But they're all franchised. So then you would have like people who are losing tons of money there. It's not like a company thing. They're all franchised.
Yeah, they're all small
like,
businesses, yeah.
Exactly. So you'd be hearing about this, you know, you'd be seeing them close, obviously, right? Because like you're not just going to pile your 401k into your Subway. You know what I mean? Like, I don't know. I don't own a Subway, so I don't know the P&L on one. But I've just heard that the franchises are actually pretty good. That may have changed.
Yeah, I think post-COVID that definitely changed, because their supply chains were surprisingly sensitive to shutdowns above a lot of other people. I don't know if you could freeze those meats, because, you know, McDonald's big open secret is everything's frozen and they just ship it. If you have more of a fresh approach, which I would hope so, because their slogan is "Eat Fresh."
Eat fresh. Is it still Eat Fresh?
I think there have been some dislocations, because you just look up Subway on Google, see what prices come up for your local Subway. You'd be so surprised.
There's one up
how
the street.
expensive it is.
I'll have to go.
Yeah.
I'll have to go. Except it'll be awkward when I go in and I don't buy anything. But maybe I'll just tell them I can't afford it. Can't go.
Yeah. Well, chicken or egg, right? Again, I know we've went on so many tangents with the minimum wage. Bottom line, there's no quick and easy answer to this.
That's why I'm here. I provide the tangents. You would stick to the script, but, you know.
And I just boosted Subway's customers just to spite me from 1 to 3 for the week.
I hope you get some hate mail for that. Also, when I was a kid, all I wanted one year for my birthday with my friends was one of those 6-foot subs. Remember those?
Yeah.
So cool. And they actually, when you order them, they make them in 2 3-foot subs, because a 6-foot sub doesn't necessarily fit in everybody's car. So you get 2 3-foot subs.
Well, how do you bake a 6-foot?
Not my problem. Not my problem. That's not what they show you on TV. 6-foot sub for your party. I was like, that's cool, Mom. I want that.
Because have you seen an oven that long? And you would have to design an oven just to.
I mean, but those big commercial baking ovens that are huge. Those are probably 6 feet by 4 feet or 5 feet. You could get like 4 or 5. I mean, you're not going to put those in a Subway just for the occasional party sub. But yeah.
All right, so I'm on a Subway online. I know this is like so riveting to hear. I'm just gonna click on BLT. I don't want to scroll. Let's see how much this is. I hope Subway doesn't sue me. Oh, at $7 for a 6-inch.
Yeah, see, that sounds better.
And then
$20 is ridiculous.
$11 for a foot long now.
You know, you were giving Chipotle a hard time earlier, and I think Chipotle is reasonable. So there you go. I said it.
You notice how
I
calmed down with the Chipotle hate?
Yeah. I mean,
it's because I became a shareholder.
I see how it is. So, I mean, I went into Chipotle the other day and like walk out of there with a burrito and I don't know, $8 or $7 or whatever.
Really?
I thought it was reasonable.
$7?
I don't know, 8, 9.
Okay, I still won't go there.
It wasn't memorable. You know, I usually remember when it's like, really that much? You know?
Yeah.
Yeah.
And again, actually thinking about it, if you look at Chipotle workers and how much they make, they do generally seem happier relative to like
great culture. Yeah, that's why you like going there. It's fun.
Like, but you go to McDonald's, you're like, yuck.
Well, I don't eat a McDonald's, but anyway.
In terms of culture,
that's a whole nother talk show.
Again. But yeah, I think the market will. The cream rises to the top in this type of market. Yes, people will be underpaid, overworked, but hopefully they can find something without intervention.
Yeah. And hopefully all the restaurants don't go out of business in Seattle and we can have places to go eat out in the future.
I think there will be a will. There's probably a way, but we just don't know yet.
There's a restaurant near us that we'll go to from time to time, and they somewhat recently added a 3% credit card surcharge fee. What? And I bet there's also a sign on the door when you walk in. We don't accept cash. You can't do that. Like, I know a lot of small businesses charge 3% thing, but there's nothing that aggravates me more. But a lot of businesses do it. And so I'll be the first to say, I saw that last time and I took that straight out of the tip.
That's 3%.
Sorry, you're not going to, I normally tip 20% there and you're going to charge me 3 to use my credit card. 17 it is. Nothing that aggravates me more. It's just like, you're just making the 3%. You're pocketing that.
Yeah, my vet charges a 3.5% credit card fee. So my wife always has to go to the ATM before a vet visit, but invariably it's like a $200 to $300 visit.
Yeah, which is like real money, right?
Yeah.
Yeah.
So those fees become pretty substantial.
Yeah. Okay. Well, that's definitely enough rambling on that topic. So,
I think that was the last top. Yeah.
That was the last topic. We did it. We got to the finish line. Okay.
So many tangents this week.
That's why I'm here. That's why I'm here. Happy New Year. All right. Thanks everybody for tuning in to episode 63. We're going to have an awesome 2025 together here on this podcast. And we'll catch you again in a couple of weeks. Take care.
All right. Thank you.